Hi, hello, good evening, friends. Warm welcome, one and all, to Nifty Banker, India's first retail Bank Nifty Traders Conference. Well, I am Ashok Devanampriya, the host for this program today. We are in the sixth session of this interesting 16 session series, friends. Today is 18 Feb, Thursday. We have yet another interesting speaker, my good friend 𝐃𝐞𝐞𝐞𝐩𝐚𝐤, who has been a professional trader, I would say a passionate trader, and we both come from the same industry. He's also a computer science guy by qualification. He's from Delhi. He has been trading in the stock markets maybe close to a decade, Deepak.
Yes.
Oh, that's quite a big time.
Yeah.
And he was an intraday trader mostly, and he has reached the level of automation also. Loads to learn from him, and let's hear from the horse. Deepak, on behalf of the entire audience here, I extend my warm welcome into the program.
Thanks, Ashok. Thanks, Ashok, for a great welcome. So, should I press the start broadcast button now?
It's already broadcasted, sir. Go ahead.
Okay.
It's your
Should
show.
I just close it? Okay. All right. So, hi guys. Welcome to the session. Today is the sixth session of the series, and I'll be taking upon a way in which we will analyze how to, anticipate a move in market based upon open interest, and much more alongside with it. So that's there. So a bit about me. I'm a full-time trader by profession. Also, I'm an IT engineer. I am a computer science engineer, and like Ashok does, I also don't do much of programming like in this field of automation that he talked about. I am getting the programs made, but I'm designing them myself, that what needs to be done and how it should be. So that is my task. And like everyone else, my aim is not to lose much and to protect capital and focus on what market is doing. Then I run a traders club in which I am live for full day market sessions from Monday to Friday, in which I teach, I share what market is doing, and I also share the trades that I'm doing alongside. Now, coming to topics for today, I'll discuss a bit about my trading psychology and style, the basics before we start, a touch upon demand and supply zones, understanding the day structure, understanding the open interest, then the option setups that I'll be discussing. That is the main topic, that is trend day setup and the mean reverting day setup. So these are the two days in which people make money. The third one, which is there, is dull day. So on dull days, no one makes money. So we are basically trying to eliminate them um, with the help of options. Now, a bit about my trading psychology and style. So I am basically a reactive trader. So my task full day is to wait for something to happen in market, and then I look to do something about it. So by this, what I mean is, I'll wait for an event as in, I basically trade based upon focusing upon volumes and references. So if you see today's index chart, today index Nifty was stronger in morning, and the day high it made was at reference which was from yesterday. And if you look at the 1 minute chart of intraday today, the day high had the highest volume of the day. So that action from market, and I will be reacting to that. Okay, at a reference we have this high volume candle, and if low of that is getting broken, I should be looking to sell. So that is the reaction that I'm going to present to what action market is doing. So I basically wait out and see if something is happening or not. If nothing is happening, I usually sit idle the whole day. The most busy time for my trading is when result season is on. So when companies are announcing results, I like to trade those events. So I prefer event trading because it is intraday and everything moves so quick that you don't have to wait for targets or stop loss. Stop losses also come that quick, and even the targets are coming in a flash. I'm a patient trader. I wait for my setup to appear. If the setup is not there, I will always be questioning myself why to take this trade if there is no setup in it. Then if I am like too much convinced that okay, this should be there, but it does not lie in my setup, then I again question myself that okay, setup is not there, and if you make loss, then again you will say the same thing, setup was not there. So why to do that khujli trade? So always ask a question, why are you taking this trade? If there is something within your studies which allows you to take the trade, allows you to define the risk, then only take the trade. Then what is this result into? This result into less than 2 trades a day for me. So being an intraday trader and doing only 2 trades is like being a positional trader and trading, I think, once a day or twice a week. So when you trade less, the probability of your success increases because you are taking decisions not based upon impulse, but after proper analysis. Okay, because you are not in a hurry to take a trade. You are always waiting for an opportunity to appear, and when the opportunity appears, then only you take a trade. So it ensures that I enter only the high probability trades based upon the setups that I have. Okay. Now let's come to the basics of the topics that we're going to cover today. So first basic will be your Dow theory. So first we'll cover Dow theory. Dow theory is one of the most fundamental theory on technical analysis. So basically what it does is it is your defining the trend. So basically a formation of higher high and higher low is your beginning of beginning or a middle of a uptrend, and change from higher high higher low to lower high lower low is the starting of a downtrend. So this can be found in all time frames. Okay, you can find the same thing on a 1 minute chart. You can find the same thing on 5 minute chart, 15-minute chart, a hourly chart, a daily chart, because it is not considering the time frame that you're looking at. It is basically taking the candles and the structure that is getting formed in front of you. Okay, so now the question arises here is, on what time frame you should be taking the structure, or you can say that on what time frame you should be considering checking the beginning of a trend or beginning of a downtrend, or assuming that, or finalizing that if it is an uptrend in which you are entering, or in a downtrend you are entering. So basically it is directly correlated with your trade time frame. If you are taking trades intraday, the chart in front of you should be 1-5-15 to do analysis of the trend of the shorter time frame or the time frame that you are trading. If you are trading swing basis, or you can say that you are taking swing basis on 15-day period, holding period is there, or a month period is there, then you go ahead and look the same chart on a daily or a weekly or a monthly time frame. So according to that, you have to decide where you are in the trend. Now let's touch upon some basics of demand and supply. So demand and supply are the most fundamental concepts in market. Again, I'll be touching all the basic and most common and most fundamental concepts. So price is a reflection of demand and supply, and these are also known as your support and resistances. These support and resistances are formed at levels where there is balance and imbalance. So what do we mean by balance or imbalance of buyer and seller? So when market, let's say, reaches a resistance level, so there is a imbalance that there are more sellers and less buyers usually, and then market reacts to it and gives a retracement. Similarly, when prices reach a support level, there are more number of buyers than sellers, and similarly, market usually gives uptick from that level, and that is, I mean, that is something we expect from market to do. At resistance, the price should come down. At support, price should take a support and should move up. So for example, this is a Dow theory on a Nifty daily chart. So as you can see, this was the recent or March low, then a series of higher high, higher low formation which had started has continued till now. So not saying that someone should have not taken a short trade or something like that, but yes, clearly there were no indication to be short based upon the recent trend that had developed from the lows. So if everyone was looking to sell into this market, it was not the technicals, it was the bias that we were carrying. That okay, COVID is there, we are down a lot, we are not going to go up, India is doomed or something like that. Okay, US is down, Trump is out, or whatever it is. But what the screen was telling is that there was a trend that was getting formed, and the trend was continuing and continuing and continuing every time. Okay, this is a shorter time frame Dow theory on a Bank Nifty 15-minute chart. So this is a recent example. So as you can see that the trend was continuing till this point, and just like today or yesterday it broke this line. So basically a lower high got formed, and you can easily see that how market reacted today, or was not looking to go up at all. So people will say that okay, I mean, yeah, they can say anything, but yeah, the Dow theory says that okay, there was a formation of lower high and the trend started to go down. Okay, so when the trend was going down, people should be looking to buy or looking to sell. I mean, most people were still looking to buy today because of this memory that okay, market has been going up and Bank Nifty is stronger and all banks are going through the roof. SBI is going to 1,000 rupees or something. But what was the chart saying? That okay, today there is a formation of a lower high in place, and the trend is shifting down in the short term. So there is a very big difference in the time frame that we are selecting. If we are trading intraday, then this daily chart may not help that much. If we are trading intraday, this 15-minute chart is helping us more because it is more relevant with the time frame of trade that we are taking. So if someone is trading expiry, he can do a 15-minute chart analysis or a 5-minute chart analysis or a 1-minute chart analysis on Bank Nifty. But if he starts to do a daily chart analysis for his trade, which he's going to do expiry trading on next couple of minutes, or holding for free 3 hours or 4 hours or 30 minutes, he will not make money looking at the daily, weekly or a monthly chart to take that trade today. So he has to come down to the level of market. So now let's focus on understanding the day structure. Okay, so there are three type of days in particular. One is your trend day. It can be trend up or trend down. Then second is your reversal days. So reversal days are basically you can say that in the first half market is up, but in second half market is suddenly down. Or you can say in the first half market is down, second half market is up. So basically complete reversal of what was happening in the initial part of the day. Then the third type is dull days. Dull days are those days in which